So ladies and gents, it's now 10:30, so it's the perfect time to start this morning's webinar. And this morning's content is entitled Starting the Journey in Relationships to Mortgages. Now let me introduce myself. You know who's speaking today. So my name is Greg March. I'm a Senior Financial Educational Coach for My Money Matters. And I've got the pleasure of taking you for the next 20-25 minutes or so exploring the benefits of starting the journey when it comes to mortgage planning. But just before we start the webinar, let me point out some information. First and foremost, the content of today's webinar has been designed and provided purely for educational purposes only. So please don't take anything that I say today as regulated financial advice. And also the information is based on our current understanding of tax treatments and legislations, and this could change in the future. And remember, with mortgages, your home can be put at risk if you don't keep up with your mortgage payments. And also this webinar will be recorded for training and compliance purposes. Now, during today's talk, if you have any questions, then feel free to ask those questions. But the only format we can do that for today is by using the Q&A box, and you can see that on the top right-hand side of your screen. So if you've got a question, drop it into the Q&A box, and then what I'll do, I'll answer that question for you at the end of the talk. Please, though, keep those questions today to a generic basis if you can, because what we can't do today is talk about you, the specific individual, in such a forum. So any question you've got, drop it in the box and I'll answer those questions for you at the end of the talk. Now, just before we start getting into the content on mortgages, let me just introduce you to why we are now My Money Matters. For those of you who've been onto our webinars before, we were formerly known as AVCwise. The reason we're now My Money Matters is we've decided to expand the education that we can offer to all of you today. So instead of offering education purely based upon retirement, what we're now going to do is give you the ability to have education and any theme that relates to your finances. So that could be debts, it could be savings, it could be estate planning, it could be insurance protection, and also retirement planning. And under each of these themes, what we're going to do is give you education that covers absolutely everything. So for today, you're here because you want to talk about mortgages. We've also got webinars on understanding your credit scores and handling debt. We've got additional material that looks at things like savings, investments, budget planning, setting goals, which could be really useful if you're just thinking of starting to get a mortgage. It kind of links hand in hand. So if you are in the situation you're thinking of getting a mortgage, then I'd highly recommend as well that you do look at the credit score webinar and also the goal setting webinar. As we progress through the content we've got access to, you've also got access to webinars that look at things like inheritance tax planning, how to write a will, long-term cares. We've got insurance webinars, and we've also, as you would expect, got the retirement webinars as well. So in addition now to just providing you with education on the share cost ABC, what we're going to do is offer you education throughout the whole spectrum of what we call the cycle of life when it comes to your finances. So it's a very holistic approach of actually looking at planning for yourself. So I would recommend that you keep coming back to the website and you make as much use of our education as you can. Ultimately, it's free to you, so why not utilize it as much as you can? So today, though, we're starting talking about the plan for the mortgage. We're getting our foot in the journey when it comes to mortgage planning. So we're going to discuss the following. The first thing we're going to look at is something called the Mortgage Market Review, which was a review that was brought in 2007 after what happened in America, and we'll touch upon that in just a moment. I'm then going to start talking about what you need to be aware of when it comes to mortgages. So the types of things like the deposits and the way in which you need to save, the types of schemes that are available for you as first-time buyers, and then we'll talk about the process itself. So all of this we will run through. Now, there is going to be a lot of information I'm about to give you today, but feel free to come back to these webinars as often as you like. So if you do miss things out, don't worry about it. You can always come back onto another webinar of the same ilk when you've got the time later on. So the first thing I want to talk to you about today is what we call the Mortgage Market Review. Now, the Mortgage Market Review in the UK was introduced in 2014, and it was brought in as a way of stress testing potential borrowers when it comes to their mortgage application. Now, the reason this was brought in is, if you can remember, in 2007, 2008, there was a major mortgage crash over in America, which caused fundamental issues with finances throughout the globe. And what the UK government decided to do was, because of that, they decided to put this thing called a Mortgage Market Review in place, which stress tested the borrowers, which simply means that you weren't able to borrow whatever you wanted to. We had to have certain limits. So when the Mortgage Market Review was brought in, what the banks were actually assessed in doing is actually question your affordability. And they had to question your affordability based upon today, but also tomorrow as well. So if interest rates went up by a certain percent, they needed to be happy that you were still in a situation that you could afford to make those payments, so you weren't a bad debtor, if that makes sense. And what they look at when they do the stress test, or the mortgage market review, when that does the stress test, they look at the following. They start by looking at your credit score to see what type of credit history and credit risk that you are. So again, for those of you that haven't been on one of our webinars about the credit score, you might want to go onto the webinar that says understanding the credit score, because that will then show you what you need to do, what you could do to improve your credit score if you're struggling to get a mortgage. The stress test also looks at your employment history as well. So they look at your history and your income levels, and they'll look at your overdraft status as well. And what they'll do when they look at the overdraft status, they'll see what your account has been like over a period of time. So they're looking for consistency when it comes to your finances. They'll also look at any savings and savings history you've got as well. And they'll take into account with the stress test any subscriptions you've got. Now, what this simply means is that when we're looking at mortgages and borrowing money generically, then borrowing sufficient funds has become more difficult because of the mortgage market review, because they have to prove your affordability today, but also your affordability tomorrow as well. And it's because of that, in 2022, the government decided to make some changes. And what they decided to do with the mortgage market review is they decided to abolish the stress test, but not fully. The principles still remain the same. So as of August 2022, when you're applying for a mortgage, the stress test technically won't be there, but the principles will still remain the same. You still have to have this affordability, and they still need to understand that you've got that history that allows you to borrow, and you will be a proper good debt rather than a bad debtor. So even though the stress test isn't there, you still need to be aware of it, because it will still impact potentially how you get your funds from a mortgage provider. So the mortgage market review, even though the stress test has been taken away, it still has some limits that you need to be aware of. And the first limit is the amount of money you're allowed to borrow is limited to a maximum of 4.5%. And this is called the loan to income value. So if you've got a salary of £30,000, then the maximum you can borrow when it comes to a mortgage generically is going to be 135,000. Now, the reason I say generically for this one is if you do shop around, there are some lenders that actually do stretch that ever so slightly, even though it's been deemed the maximum should be 4.5%. There are some lenders that do stretch that. There are other lenders that are a little bit less. So if you're looking to get 4.5 times your income, then just make sure that you find the mortgage provider that's prepared to give you that. If you need more, then do shop around, because you will find one or two out there that can offer you slightly more. And when you're applying for a mortgage, there are two types of mortgages generically you can apply for. There's one mortgage called a repayment mortgage, and that simply means that every single month when you make a payment back to the mortgage provider, part of that payment goes towards reducing the debt, and the other part goes towards the interest. Now, a repayment mortgage is generally more expensive than the alternative mortgage, which is known as an interest-only mortgage. So an interest-only mortgage is where you're borrowing money from a provider, and when you make your payment back on a monthly basis, all you're paying back is the cost of the loan, so the interest itself. Now, these are lower, as in a lower charge to yourself, but you need to ensure that if you do apply for an interest-only mortgage, and they are quite hard to get hold of nowadays, but if you do try to get hold of an interest-only mortgage, what you have to do is you have to have proof in place that you've got a credible repayment strategy. So interest-only mortgages will be cheaper in your pocket to start with, but you still need to ensure you've got a credible repayment strategy going forward. And that's important that you understand. So when you're applying for a mortgage, you've got the repayment strategy where the debt decreases each month. And with an interest-only mortgage, the debt stays the same, but you have to have a repayment method in place. So this is the big thing when we're looking at starting the journey and mortgage planning. What does it actually cost us? Now, the first thing that most of us are aware of when we do decide to save towards a property is that we have to have a deposit. Now, the deposit level generically is 10%. So a typical deposit is roughly 10% of the purchase price. Every now and then you do get one or two banks or building societies that do come out and they'll drop this to maybe 5%. So again, do your research, because if you're struggling building up sufficient deposits, be aware you might get one or two banks that do bring that down for first-time buyers. There are one or two institutions out there now that do 95% mortgages, so you just need a 5% deposit. So do that research if you can. But the reality is, though, the bigger the deposit that you can put down, the lower potentially the mortgage rate that you're going to be it's going to be applied to, because you can be less of a risk the more deposit you put down. So the less the rate on the mortgages that you take could be applied. So even though it is possible to get different mortgages where you don't need such a big deposit, it could be in your interest to actually build up as much deposit as you possibly can, because it could reduce your overall cost to the mortgage itself. Now, in today's marketplace, 5%, 10%, it doesn't really matter. It's still a very expensive thing, and a lot of people are struggling to get on the mortgage ladder. So what I'm going to talk to you about now is what support you can get. So there is support from the government and potentially support from your family as well. But I want you to be 100% well aware of what the implications are if you do request for family support. So let's start off by talking about government support. So what products are in the marketplace that could help you maybe save for that deposit? Well, the first thing I want to talk about is something called a Help to Buy ISA. Now, for those of you that aren't aware what an ISA is, it's an individual savings account, and it's a savings account that is wrapped in this protective wrapper, which simply means that any funds inside that account, when they grow, there is no tax to pay. Now, this was an incentive set by the government, but unfortunately it's closed to new members. So in 2019, this closed to new members. But it could be possible that members of the audience today have a Help to Buy ISA because they haven't yet found the house of their liking. So I just want to touch upon this one, and then we'll talk about what the government's brought in most recently. So under the Help to Buy ISA, so it's just a savings scheme that allows you to pay into the scheme if you've already got one, into pay into that scheme until November 2029. And by doing so, you'll get a bonus, but that bonus must be claimed by November 2030. So what does that mean? Simply, you're allowed to save into the scheme until 2029, but you must have bought your house by 2030 for this to work. You're allowed to pay into the scheme and the Help to Buy ISA up to £200 per month. That's got an overall maximum cap of £12,000. And the government generally gives you a bonus of 25% of your savings. So if you've got to the maximum of 12,000, then they'll give you a bonus of £3,000 that goes towards the deposit. And remember, all of this is tax-free. One of the stipulations, though, on the Help to Buy ISA is that the minimum bonus that's applicable is £400. So that means you must have put in £1,600 between now and when you claim on the Help to Buy ISA to get any form of assistance from the government. And the other restriction on the Help to Buy ISA, there's when you go into this ISA, it is an investment into cash only. So a Help to Buy ISA, we can only go into a cash-based investment. Now, if you're in a situation there's two people buying a house and you're both first-time buyers, then you're allowed to have two Help to Buy ISAs as well. So you can use multiple ISAs when it comes to that deposit. And the thing you've got to be aware of, though, with this scheme is that access to the scheme only comes in on completion. So for some people, they're looking for the deposit and they might need to put the deposit down before the mortgage completes. So even though the scheme kind of helps, it gets paid out at the wrong time. So you really could do a scheme that gets paid out maybe on exchange, which is before completion. But we'll come back to that in just a moment. And there are limits to the value of the property as well that you can buy with a Help to Buy ISA. So what the government stated was there'd be limits on property values up to £250,000 throughout the whole of the UK, excluding London, where London you're allowed to buy a property up to £450,000 with this scheme. So the Help to Buy ISA was the original scheme brought out by the government to assist people getting onto the property ladder. The downside is it doesn't pay out until completion. There are limits on what you can have when it comes to a house size. Unless you're living in London, then those limits might be a little bit low for some. And remember, if you've got one, it closes on the November 2030. So if you haven't bought your house by then the bonuses aren't paid. So the government looked at this and they realised that what they brought out was a good scheme, but there potentially could have been a better scheme that could have brought out. So they introduced a new scheme. And the new scheme introduced was known as a lifetime ISA. So again, it's an individual savings account where you can save and not pay tax. And they've called it a lifetime ISA because it gives you different options. So in the marketplace, this is known collectively now as your LISA account. So it was introduced on the 6th of April 2017 to help to save towards mortgages, But you could also use it, though, as a savings scheme for retirement. So if you don't get to that stage when you don't find your house, you don't lose the benefits like you do on the Help to Buy ISA. This one you can actually take out in retirement and still get some benefits. Now, to take out a lifetime ISA, you've got to be between age 18 and 40, so 39 and X amount of days, so not 40 itself, just under 40 to apply for the ISA. So if you haven't got one of these, you might want to consider going and get one today from your banks or building societies. Speak to your financial advisor, because it could be a good scheme for you to assist you in saving for either your first time purchase of a property or even to help towards retirement. Now, again, there are limits on what we can put into this scheme. So again, under the lifetime ISA, the limit's been set by the government of £4,000 per annum. And you receive a bonus of approximately 25% of any monies that have been saved into that scheme. Now, the government stops paying bonuses after your 50th birthday. So anything that goes in the scheme, you'll get that bonus up to your 50th birthday. So the maximum bonus you can get from a lifetime ISA is going to be £1,000 per annum. So that's the maximum you're allowed to receive. So you put in £4,000 per annum, they give you an extra £1,000. So it's £1,000 for nothing in reality. So what the lifetime ISA or the LISA is used for then, generically it's used to fund a deposit. Now, do you remember the Help to Buy ISA was paid on the completion? So that's the back end of the retirement of the mortgage journey. This is actually paid upon exchange, which is a big difference. So it's paid upon exchange of the contract rather than the completion. So you got a little bit of time when that money is actually required. And you've got to have saved into the scheme for a minimum period of 12 months to benefit from this as well. Now, when you come to buy your property, the value of the property is set irrespective of where you are in the UK. So if the Help to Buy ISA was very London orientated with a 450 in London and 250 elsewhere, under the LISA scheme, it's for a property value up to £450,000 anywhere in the UK. Now, if you don't use your LISA to buy a house or to use it as a deposit for the house, at the age of 60, you can access your LISA tax-free. So you could use it as a way of just putting up an extra pot of money for when you get to retirement or getting close to retirement, if that makes sense. Now, you can access a LISA early. So you can request to get the funds from your LISA without having to buy a house or without getting to the age of 60. But if you do that, there is a penalty applied. Now, that penalty is 25%, but it's not 25% of what the government's given you. It's 25% of the whole of your ISA value. So take that into account if you're going to break this account early. That penalty is applied on what you've put in plus what the government's put in. So it actually costs you a fair amount. And the other difference between the Help to Buy ISA and the lifetime ISA, in the lifetime ISA, you have the ability to invest into cash if you wanted to, but also you could also go into the stock market as well. So you could go into a stocks and shares type of investment where there is a bigger potential for return, but also a lot more risk as well. So that's down to the profile for yourself when we're looking at investing. And as you'd expect, any form of ISA forms part of your £20,000 annual ISA allowance. So when you're looking at this one, if you're a first-time buyer, you can use 2 times LISAs as you can with Help to Buy ISAs. But under this one, you do have the ability to go into the investments. So just be aware that investments can fluctuate and they're not guaranteed, and you can get back less than you've put into these schemes. If you're really risk adverse, you might just want to consider the cash and benefit from the bonuses given to you by HMRC. So that's the government support, but you also potentially could be looking at family support as well. So there is this thing called guarantor support when it comes to mortgages. Now, I want to explain how this works, just so you can see the benefit, but also see the risk as well. So a guarantor support is a special mortgage if you're struggling to raise a deposit or you've got poor credit history. So again, if you're in that category where you are struggling to raise a deposit or got poor credit history, I would recommend that you go back on one of our webinars that we're running that looks at credit scores and also looks at setting financial goals and shows you how to build a deposit potentially a little bit more effectively. So if we look at this one, just 1 second while I get my mouse working properly. There we go. So if we look at this one, it's a special mortgage, and you go to basically family members or close friends and ask them to give you some assistance when it comes to funding the mortgage. So what a family member would do is that they would step in if you weren't able to make your payments. But they must be homeowners and prepared to put their house and or savings online in case you're unable to make those payments. So it's easy for all of us to say, oh yes, it's a fantastic thing that we'll do. We'll all become a guarantor for our son or our daughter's mortgage. Let's say, they're in the early parts of actually getting a property. You've got to understand that if the payments aren't made for whatever reason, and it could well be that they split, the divorce, if they're in a relationship, and you're the guarantor, then you're putting your situation at risk as well. And it happens quite often. So if you're looking to become a guarantor, what I would say to you is get independent legal advice before entering into a contract, because it may look like the best thing you can do today by helping them. But if anything does happen in the relationship, if they're in a relationship and they split and their payments can't be made, or if their payments can't be made going forward, then you are putting potentially your own property and your own savings at risk. So it is a very big undertaking. And all I would say is just make sure you know all of the pros and all of the cons before you sign on that dotted line. So that's your guarantor support. We've spoken about the government support. So let's now talk about things outside of the deposit that we have to save for. So when you're applying for a mortgage, you need to know there are lots of fees that are associated with mortgages and mortgage applications. And these can get quite daunting. So you've got your initial fees, which we're going to talk about. You've got legal fees, which we'll touch upon. And also you've got stamp duty as well. So what I'm going to do, I'm now going to take you through a couple of slides that will have lots of figures on. So bear with me with this one. But what I'm going to say to you is this: you need to be aware of this. So if you need to, just come back to these webinars later on. And then if you forget things, you can always come back and just have a look at these figures again. So when we're looking at setting up a mortgage, then the generic fees that we've got are as follows. So the first fee we need to be considering is the arrangement fee. So this is the fee that's actually paid to your mortgage provider for setting up a loan. And those arrangement fees can range from zero, so that might be part of your strategy, to £2,000, and they can add it to the loan for you. But remember, if they add it to the loan and that loan's been charged interest, it means that this has been charged interest for the next 25 years as well. So you might want to find a way of actually saving this for yourself. You've got a booking fee, which is, again, another fee charged by the mortgage providers just for booking the mortgage itself. And then you've got a valuation fee. Now, the valuation fee is paid to the lender to carry out what they call a mortgage valuation, i.e. the mortgage provider needs to be in a situation that it is clear that the value of the property you're looking at is mortgageable. So they have to have a valuation to find out what that will be. So it reassures the lender that the property is the right property and that it's a sound mortgage proposition. And that can vary again between £0 to £1,500. So again, shop around for this one. And like everything else in life, you don't get much for free nowadays. So once the mortgage is then complete and you're sending your money across to the banks, then there is a telegraphic transfer fee as well, and that ranges between £25 and £50. Now, all of these fees all start to add up, so just be aware of that one. Under the legal side, what generically you've got is you've got a broker fee. So if you've got a mortgage broker that's helping you choosing the right mortgage product, which you don't need all the time, you can literally get your education yourself and go and speak to your bank on your own. But if you need a mortgage broker, they can charge you between £500 and £600. Now, a survey fee, this is not legally binding, but it's one of those fees that I think is the most important things to be doing. What a survey fee does, it looks at the property itself, it surveys the property, and it tells you if there are any potential issues. Now, buying a house, especially for the first time, is one of the biggest purchases you're ever going to make in your life. It's worth spending the money to make sure you have the right survey fee, so you know that the fact you're not on mines and the house is going to suffer from subsidence. So it's up to you what you decide to do, but surveying fees, not a requirement. But if you're borrowing the money, the last thing you want to do is get yourself in a property that's got loads of issues because you haven't paid for that fee. And then, as you expect, you've got solicitor's fees. So the solicitor generically is the individual that's going to handle the sale or the property, whatever, of the property, or the purchase of the property. So they do the conveyancing, and they'll charge you between £1,300 and £1,500. And then disbursement fees are basically other fees such as land registry searches, anti-money laundering, and that generically comes in to about £500. So as you can see, there's a lot of fees we've had to cover so far. Now, there is another fee that you need to be aware of. Now, this might change, but this is how it currently stands. So there is something called stamp duty that we need to be aware of. And stamp duty, the rate of it is dependent to where you live. Now, I've had a quick look at the delegates today, and I think the majority of you are in England and Northern Ireland, so I'll cover this slide, but there are different stamp duties for different areas like Wales and Scotland. And if you want to find out about stamp duty, what I recommend you do, if you go to stampdutycalculator.org.uk, and then it will tell you what stamp duty potentially you're going to pay. So what you've basically got is up to £250,000, then we don't have stamp duty, but if you're a first-time buyer, then that could go up to £425,000. Now, anything over that, so if we're a second-time buyer, anything over 250,000, we then start paying stamp duty. And you can see the rates on the screen of 5%, 10%. And if you're buying a really nice property, then it can go up to 12%. So with a first-time buyer, any property costing between 425 and 625, that's when you'll start paying that 5%. And in addition to that, over 6.25, then the 5% applies to the full value. Now, what I would say is when you're looking at this potentially is going to change in 2025, where the nil rate, so the 250 or the 425, you're a first-time buyer, that's potentially going to drop. Okay, just so if you're thinking of buying a house and you're thinking about the fees, just be aware that the stamp duty nil rate band, the starting band, potentially will drop in 2025. But that's in the future, things could change, and just be aware of that if you can. So this is for England and Northern Ireland. You've also got different forms of stamp duty for Scotland, and you've also got different forms of stamp duty for Wales as well. If you're from those regions and I haven't covered these quick enough for you, just drop me an email when we've finished and I'll send you a copy of this slide. So first-time buyers, we've spoken about first-time buyers, but there is a definition to what a first-time buyer actually is. So let me explain that definition just so you're aware that you fit the category. So a first-time buyer is defined as someone who has never owned a freehold or a leasehold interest anywhere in the world. It also must be for your main residence. So when you're buying the house, it's got to be for your main home. If you're jointly buying a property, then both of you must fulfill the first-time buyer statement. So if you've got one person that's buying a second house and one person that's buying the first house, then the stamp duty rates won't be reduced. And also remember, if you're buying a property, let's say with your parents, this could impact your first-time buyer status as well. So if you've got a guarantor on the mortgage or you're buying it with your parents themselves, that can have an impact upon your first-time buyer status. So just be aware of that when you're looking at what you just discussed when it comes to things like stamp duties. And then let's look at the approximate cost then for the purchasing of property within the UK. So the approximate cost of buying a house in 2024 in the UK, and this looks at all regions. So I know if you're sat there and you're in the south thinking, well, you know, we can't even get a garden shed for this. Remember, this covers all regions of the UK. So the average property is 277,000. So that means that if we're looking at what's the average cost to buy that house, including your deposit, you're looking at approximately £33,000. So it's very expensive getting yourself onto the mortgage ladder today. But it's not impossible. Every generation's had the same type of issues, so it hasn't stopped other generations before. So it isn't impossible. We just have to put those plans in place. And what I would say to you is, again, if you want more information upon how these fees have been shown, go to comparemymove.com, and then you'll see a lot of the information that we've shared with you today. So this is part one of a two-part mortgage webinar. And the reason we've broken it down, there's just lots of figures that we've thrown at you today, and you need a little bit of a break to kind of let this sink in. And then if you want to come back to the second part, and we're running the second part, I think, later on today, but we will always do it on a Friday for you anyway. So if you wish to come back, the second part of the mortgage webinar is where we start talking about the types of mortgages you can get in the marketplace. So this is like the repayments, your interest onlys, the trackers, the fixed rates, the discounted rates. We'll explain all of those to you. And also the types of protection that you'll normally be offered when you apply for a mortgage, and is that protection right for you? So we'll talk about the pros and the cons of those protection policies. And then we'll summarize everything for you going forward. So part one, we've done, tick the box. Come back to this as often as you want. If you need to maybe just kind of go through it again at your own pace, then feel free to come back. but you might want a little bit of support when it comes to the mortgages. So one thing you could do is if you go back to our My Money Matters platform, and if you look at the platform itself, what you will see is you've got different little tiles that are available. So these tiles represent different things. You might want to click on this one here called Snoop, because what Snoop can do for you, not only can it help you with things like your budget planning and showing you how to create a strategy going forward, but they do have support for mortgages where they can look at the best mortgage rates in the marketplace at any given stage. So you might want to register for Snoop. It's just an app that you get on your phone. It doesn't cost you anything if you go for the basic package. And then what you can do when you've got 5 minutes in your lunch break, just flick through. If you're looking for mortgage, see what the best mortgage rate is and see if it fits your own particular style going forward. So look at that if you can. And as we've already discussed as well, there's lots of other information that we can run for you when it comes to educating yourself now in any forms of finances. So we do run education on retirement, on savings, on mortgages. We've got estate planning, which is things like inheritance tax and wills. We've got insurances, and we've also got debt and money management as well. So look at all of these webinars, get yourself in the routine that you come back as and when you can, and just build up your knowledge when it comes to your finances. And all of this is offered to you completely free of charge, but it could actually save you a lot of money in the future. So hopefully you found today's webinar of use. If you do have any questions, then feel free to contact us directly. So you can go to customer services and contact us on the telephone number or the email address that you can see on the screen. But if you've got specific questions about content you don't think's on our platform, but maybe you'd like some content created specifically around a certain area of finances that we haven't looked at, just drop me a note at suggestions@mymoneymatters.co.uk, and what I'll try to do is put that content on the platform for you so we can tailor the content for yourself. So hopefully you found today's webinar of use. What I'm going to do is just jump to a different screen to see if there are any questions, and there's no questions come through. So what I'm going to do then is I'm going to bring the webinar to a close. So ladies and gents, thank you very much for your time and attention today. Hopefully you found today's webinar of use. Hopefully it's made you think, and we'll speak again in the future. Take care. Bye-bye.